First quarter GDP smashing expectations today at 3.2%. The surprise gain beating economists' estimates of 2.3% growth. President Trump's touting the report earlier. Take a listen.
The GDP numbers were just announced, and they were far higher than even the high expectations. There were many people thought it would be less than 2, and they were at 3.2. Inflation numbers are very low. The gasoline prices are coming down. I called up OPEC. I said, you got to bring them down. You got to bring them down. And gasoline's coming down. We're doing great. We have great growth and also very, very low inflation. Our economy is doing great. #1 in the world.
There you go. President Trump talking about those GDP numbers earlier. Joining us now is NYU professor of economics Larry White, along with Joseph Minarik. He's a former OMB chief economist under President Clinton and chief economist at the Committee for Economic Development. Larry, I want to start with you. If you look at the headline numbers, no question these were strong compared to the expectations.
Absolutely.
3.2%. Why aren't we seeing a stronger reaction in the market?
Markets are always trying to anticipate what's going to happen, and they may well be looking a couple of months, couple of quarters down the road. There's, I think, a good case to be made. This has been due to a number of one-off things. For example, we've recovering from the government shutdown that was at the end of the last quarter. There's some one-off international trade things. Look, I would love for this strong growth and low inflation and low unemployment all to persist, but I wouldn't want to bet the farm.
When you say it's a one-off, does that suggest that you think the 3.2% is not sustainable?
That's unless we get a surge of productivity growth, you can't sustain this. I hope we can get that surge of productivity growth, but without that, we're not gaining a labor force that would allow us to persist with high growth. We're not getting the investment numbers. We still don't have the infrastructure being built, and so I don't think it can be sustained.
Joe, you heard Larry say right there that he doesn't think 3% growth can be sustained. You agree?
We're not going to argue very much. If you look at two of the categories that Larry mentioned, I'll add one more: inventories, which is a kind of a one-time change. Those accounted for 2% of the 3.2% growth. You expect those numbers to recede to smaller, sustainable levels over a long period of time. The 2.3% consensus, I think, is about where we're going to wind up by the time the year is out. So this is it's a good quarter. Fears of recession, I think we can put aside a little bit, but we should not be too effusive about the notion that we're going to have 3% plus growth over the rest of this year. That's unlikely.
Joe, you heard the president commenting on the back of this earlier, saying low inflation multiple times, stressing the point. We heard economic advisor Larry Kudlow earlier stressing low inflation as well, saying on CNBC that he thinks this could open the door to a target rate reduction from the Fed in the months ahead. How do you think the Fed assesses the numbers that came out today?
Well, the Fed has at this point pretty much said that they're going to be on hold. They're going to be watching the inflation numbers. Might consider, in the extreme, if you had a decline in inflation, the possibility of reducing interest rates. But that's pretty far down the road, I think, in terms of possibilities. It's great that prices are as stable as they are. A part of that is the fact that this is just an incredibly competitive economy in the United States and worldwide. But interest rates relative to the long-term averages are already very low. You can't go too much down from where we are right now.
Larry, if you break down sort of the numbers underlying that headline 3.2%. We also saw private sector consumption, the slowest in nearly 6 years. Consumer spending was up, but it was at 1.2% compared to 2.5% in Q4. And then durable goods spending down 5.3%. That is the worst since 2009. When you look at those numbers, what sticks out to you the most?
Well, the decline in durable goods, and I think what we may be seeing there is the consequence of price increases, in turn being driven by those tariff increases on basic steel and other metals, aluminum, as well as on things like clothes washers, and just also, I think...
Because that's pushing costs higher.
Yeah, that pushes costs higher, and despite the president's claim that it's the folks overseas who are going to be paying those costs, the evidence is so clear. Those are costs that are getting pushed onto the backs of the American consumer. No question about that.
So let me try to build on that point, Joe, with you, because what we've heard, at least with the tariff issue, is that the U.S. and the Chinese are increasingly closer to some kind of deal. There's still questions about whether that would roll back the tariffs, but what kind of impact do you think that kind of deal would have in unlocking the higher growth potential?
A deal would help in two ways. Number one, it would enable many of the channels of international trade to open up again, which would be good for all parties, for all countries. The second thing it would do is it would dissipate a dark cloud that is really hanging over the economy. If we got to the point where it looked like we were in fact going to be extending these disputes and there might be even more retaliation, that would be one of the worst things that could happen. So trade is extremely important, and our negotiators have got to find a way to come to a deal that is satisfactory to all parties.
Okay, we'll have to leave it there. Thanks to both of you, Larry White and Joseph Minarik, joining us.